Okay, so you guys can hear me, right? Pardon me if my voice is low. So can you guys hear me? Okay, I'm not really feeling that well today, so because you guys have to bear with me. So today's class is on directional bias. Directional bias is basically you trading in line with what the higher time frame is saying. Because normally, even if you decide to look for a market structure shift to the downside, inducement and point of interest, when the market is bullish, you will see it. If you are looking for a POI to buy when the market is bearish, you also see it. Market will present you with multiple zones, multiple order blocks, multiple breaker blocks. The thing is that not all of them will hold because not you have to trade in line with what the higher time frame is saying. That is when directional bias comes in place. So if you pay attention and notice, when I'm buying a pair, I'm focused majorly only on buying that pair for a long period of time. The longevity in buying that pair lasts for a long time. And then if I'm selling, I also just focus only on sales for a long period of time due to me trading in line with what the higher time frame is saying. Now, normally we already know that there are three ways that price makes its movements. Either market is trending to the upside, or is trending to the downside, or is ranging. So normally we have an uptrend, higher highs, higher highs, higher lows. Then we have a downtrend, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. Then we have a ranging market, which is support, resistance, resistance, support, support, resistance, resistance, support, support, resistance, resistance, support. Now, the same way that price acts on a higher time frame, the same candlestick and everything, the same thing that market does on a lower time frame. The only thing is that the higher the time frame, the longer it's going to take for the cycle of the market to complete. For example, if this is a 1 minute time frame trade and this is the zone that your target is, if market hits that zone, it will probably take like 5 minutes or 3 minutes for your target to hit. But if your trade is on a daily time frame, it'll probably take a whole month or 2 weeks or 2 months. This buy on gold that I've been buying since May, this is already June ending, and we have not yet gotten to the final target. We'll probably been buying this same buyers for more than a month now. So that is why when dealing with directional bias, I focus mainly on looking at the daily time frame or the 4 hours time frame because it takes a long period of time for the cycle that I get on the daily time frame and the 4 hours time frame to complete. So when it comes to looking at directional bias, you focus on more on looking for the directional bias of the market on the daily time frame or on the 4 hours time frame. And when you do that, you focus only on trading that bias until that whole cycle of the market has been complete. Now, originally, we know that we have three ways that market makes its movement. Either price is trending to the upside, or is trending to the downside, or is ranging. Now, when it comes to directional bias, we focus on joining continuations of a trend on the higher time frame. If price is bullish on the daily time frame, like if your daily time frame is bullish based on the trend, because if you open up gold, you notice that gold has been trending to the upside for a long period of time. It's basically just trending up, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So this is what gold has been. This has been bullish for a long time. So gold has been what overall bullish. So anyone that opens up this chart can see that gold is bullish because of the series of higher highs and higher lows that is making. So now that is how one of the so now that you have your gold uh daily time frame bias is bullish. So first of all, what you do is whenever you open up any pair to analyze, go to the higher time frames like the 4 hours time frame and the daily time frame. These are the two time frames that I work with for the directional bias of the market. I'll observe the pattern that market is following at that particular time frame. If the higher time frame, the price is bullish overall, I focus mainly on looking for that bullish move. And if it's bearish, I focus mainly on looking for a bearish move. And if it's ranging, I focus more on buying or selling when price comes to support or resistance. But the thing is, you don't just hump on or hump into the market and start buying or selling without getting proper confirmations and your analysis. So this is what I do. Let's say that price is on an uptrend already. Once you open up your chart, you can see price on a clear uptrend, making higher highs and higher lows. So there are two ways that you can draw out your trends. First of all, you can draw it out with a trend line, or you can draw it out, or you can mark it out with zones. This is what I mean. So for example, if you open up your charts, let's say gold, and gold is bullish, and you see that gold is turning to the upside, it's either making a series of higher highs, then higher lows. It will make higher highs, it will make higher lows, it will make higher highs, it will make higher lows. So if you want to get this, I can connect it with a trend line on the higher time frame. But at the same time, you have to pay attention that wherever market is bouncing down to make a higher low is also in line with zones. If you pay attention, this is reacting at a breaker block here on the daily time frame or the 4 hours time frame. And this also is writing from a breaker block also on the higher time frame. So whenever market makes a higher high, while it's pulling out to make a higher low, it will bounce at the zone. But the zone will also connect with your trend line. So this is something that you have to get. So the zones that price can possibly pull down to, you have to mark them out. So in this scenario, this is also a breaker block that is also in line with this trend line. So it's, for example, now this, if you draw out your trend line, and you pay attention, your trend line also matches price reacting to your zones where there are possible reversals. This first one here reacted from this breaker. This second one also reacted from this daily breaker. So that's, if you pay attention, when market is trending, whenever it pulls down to make a higher low or a higher high or whatever, it always reacts at a particular zone. So now what you do is you wait for price to come to those zones. So normally, first thing that you identify is what the trend of the market at that particular moment, the pattern that price is using to move. If you identify an uptrend, what you do is, okay, you already know that market is bullish, you start waiting for zones where price can possibly come to. So firstly, if it's a bullish move, we don't try to sell or anything like that. We just focus more on looking for the bullish continuations. Whenever price is on any particular trend on a higher time frame and you're looking to take trades, focus on taking trades in line with what the higher time frame is saying. So if you have a bullish daily time frame, focus on looking for bullish moves. But the thing is that you have to know when to jump into those bullish moves. Don't just enter the market and start buying at any given zone. You have to know the zones to jump in and when to actually get out. So the thing is that you already know that the behavior of the market is what? An uptrend. And an uptrend is made up of a series of what? Higher highs, higher lows. Higher highs, higher lows. Higher highs, higher lows. So it means that for every high that market makes, it will pull down to make a higher low. That is already the behavioral pattern of an uptrend. For each high that market makes, it will pull down to make a higher low. So what it means is that while price took out this new high, eventually it's going to make a retracement to make a new what? A new higher low. So what it means is that you now start looking for possible zones where price can pull down to. This is on the daily time frame or on the 4 hours time frame. So let's say price is here, and already you've noticed that the behavior of the market is higher highs and higher lows. So you mark out your trend line and also make sure that your trend line is also in line with a zone where price can possibly bounce to. So if you check, while price will now have this breaker block up here. So when price bounces on the breaker block, price is already at an area where there can be possible reversals. It's just something like this. Market made a higher high, then bounced to this breaker for a higher lower. Price is here. You've gotten the first part of it for the directional bias. That price already at this zone where there can be possible reversals. Same thing, when markets made a higher high, eventually it pulled down to make a higher low. While this was making a higher low, it was also bouncing at this daily time frame breaker block. So the bounce of the trends will also react at zones where markets can cause possible reversals. It depends on the time frame. It depends on the pair and the behavioral pattern of the pair at the moment. This GJ, this particular one, the last buy I took that was in line with this trend line, price bounced at this other block zone. This is another block or a demand zone, but this was where price bounced around this zone. So as long as your trend line connects with zones where market can actually cause possible reversals from, then it's solid. So either an order block zone or a breaker block zone. Are you guys following me up, please? So it depends on how the market is moving. Sometimes it will the zone that it will bounce will match an order block zone. Sometimes it will match a support zone. Sometimes it will match a breaker block. All you have to do is just draw out your trend line. Then the trend line will tell you whether price is going to bounce from the breaker zone or the order block zone. Whichever zone it bounces, as long as that zone is a possible reversal POI. It can be an order block, it can be a support zone, it can be a breaker block, but as long as it matches in line with your trend line. So this, for example, the pattern that this market is using for gold is always bouncing from breaker, bounce from breaker here, bounce from a breaker here. So this breaker is also in line with the next bounce of this trend line. So what you now do is when price comes to those zones where you are expecting those possible reversals from, you've already confirmed that price is at a zone where possible reversals can come from. But you don't just jump in and start taking buys. No, you now have to go down to lower time frames and then look for confirmations that will confirm that the buys are going to actually come from this zone. Because sometimes price can come to your trend line and eventually just break it and start going down. So we are trying to avoid this happening. So to avoid this, you have to get markets giving you the strategy that you trade for reversals while it's at this particular zone where possible reversals can come in. Let me say it again. To avoid market coming to your trend, let's say you're on it's a trend like market and you're expecting to take a buy at a possible zone, to avoid market hitting that zone and then eventually breaking, for you to confirm that that zone is valid, you have to wait for market to give you the strategy that you trade for reversal while it's at that zone that you're expecting that reversal from. So for example, we already know that this is an uptrend. So likely what we're expecting for market to do here is to what? Give us another higher high. That is the behavioral pattern of an uptrend. But to confirm that this market is actually bullish, you have to wait for market to give you a market structure shift to the upside while at this zone, give you your inducement, then come back to tap a point of interest. Only when that happens, while market is at this particular zone, is when you can confirm the next move to the upside is now valid. So what you do is when price is at this zone, sorry, you guys following me up? I hope you guys are following me up. People, you'll be teaching, someone will be asking you to show them something when you're not yet done teaching. You're teaching something else, someone's asking you to show something else, and you're not even done explaining the first one that you're explaining. Why would not focus on the one I'm teaching first and learn from it before we move on to the next point? Why not do that? So so for we are still in the uptrend scenario. Like I said, there are three ways that market moves: uptrend, downtrend, and ranging market. We're going to go for the uptrend, we'll go for the downtrend, we'll go for the ranging, but we're still at the uptrend. I'm not even done explaining what I'm explaining. So, like I said, when market is bullish, it will always make corrections. When a new higher high has been made, market will always make a correction to make a higher low before a new high will be made in the market. So the zone market will always pull down to certain zones, and those zones are always in line with either your trend line or at possible points of interest zones. So the pattern of the market at that moment will tell you whether it's going to be at an order block zone or at a breaker block zone. You just have to draw it out, draw your trend line out with the pattern that market is already following, then draw out the possible zones where price can come to. So whenever price comes to that zone, what you now do is now go down to lower time frame. So let me just use this as a daily time frame example. This whole candle here is your daily time frame, and price is approaching this breaker block on the daily time frame while also being in line with your trend line. So when price approaches that level on your daily time frame, you don't just hump in and start taking a buy here. Not only will your stop loss be extremely large, but it's actually very risky because price may eventually still break that trend line and you will not know. Do you understand? So what you have to do is while market is here, you have to now go down to either 15 minutes time frame, 30 minutes time frame, 1 hour time frame, 45 minutes time frame, 5 minutes time frame, depending on how volatile the market is at that moment. If the market is very volatile, you should reduce your time frames and go down a bit, like 5 minutes, 15 minutes. If it's not really that volatile at that moment, you can use 1 hour, 45 minutes. So what we're expecting market to do is while price is coming down to this zone on the daily time frame, is you're just going to be seeing like huge candles. You can see one huge candle, 2 huge candle, 3 huge candle, 4. Like you can see multiple candles there, but it's not really going to be that clear to you. But once it's at this zone where reversal is expected to come to, what you now do is now go down to the lower time frame. So let me just use these 2 time frames. Let me say this candle here is the one for the 4 hours or the daily time frame, and the second candle here is going to be for the 15 minutes time frame. Let me just assume that when price is already here on the 4 hours time frame, on the 15 minutes time frame, price is also there. But the difference in the 15 minutes time frame and the 4 hours time frame or the daily time frame is that the 15 minutes time frame will give you more details. So when price is approaching this zone on the daily time frame, it can do so using these huge candles. But on the 15 minutes time frame, price may be doing something like this, making lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. So on the 15 minutes time frame, price may be trending to the downside, while on the daily time frame, markets will be approaching this POI with huge candles. So when price is here on the daily time frame, on the 15 minutes time frame, price is also going to be here because it's the same fixed point. But the behaviors and the pattern that price used to approach, they will be different. Because on the daily time frame, you will see these huge candles, but on the 15 minutes time frame, you can see market doing something like this: lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. So let's just assume that price is already there. Let's say this is the zone that price is for the 15 minutes time frame, and it's also at that level on the daily time frame. So you don't just start buying while price is at this zone. You have to now wait for extra confirmations. It's that confirmation that will tell you that this market is actually going to hold while at this zone. So what is the confirmation we are looking for? Once price is already there on the 4 hours time frame or the daily time frame, what you now do is to go down to the lower time frame on the 15 minutes time frame. What we are now expecting is for price to give us what? A market structure shift by taking out this last high. Once this last high has been taken out, we're now expecting price to give us what? An inducement, then push up again. Now, with the rules that you've been given in picking a point of interest and the rules you've been given to picking a POI, you already know that first of all, you have to confirm a market structure shift, or there is a first pullback that market will give you. Thirdly, you have to now confirm a POI that is unmitigated and the one that is closest to your inducement. So in this scenario, while price is here and this whole thing is happening on the 15 minutes time frame, price may just be giving us a little push to the upside on the daily time frame, something like this. But when this is happening on the day, so once market does this and this is your inducement, once price does something like this, then comes back to trigger your POI, which will be a breaker block here, or another block, depending on where your inducement is. But once price gives you this pattern, while it was at this zone you were expecting reversals from, that is when you can now say that market is now confirming the next move to the upside. So once this happens and price starts seeing here and it starts buying, that's when you can confirm the next leg to the upside that is valid. So only when price gives you the strategy that you trade for reversals while at the zone that you are expecting reversals from, that is when you can now confirm that the directional bias of the market is now bullish. Now, mind you, this is the daily time frame. This is not the 15 minutes time frame. This is not a 30 minutes time frame. For price to hit the expected target, market can take a whole month. So it means that for that whole month, you should be focused only on buying for that particular pair that you analyzed like this. That was why I got this buy on gold when price hit this zone. I went to lower time frame and I got my confirmation. Once that thing happened at that level and I got that confirmation, I was only focused on buying gold from that May till now. I've not tried selling gold. We only sold gold as a scalp. But the main bias of gold was what? It being on an uptrend. Now, the thing that most people do is now closing out their trades too early. Now, you already confirmed that market is bullish when you gave us this market structure shift inducement and our point of interest while price is at this level that we're expecting reversals from. Now, once this happens, you now have to look at where market is going to, the target of the market. Now, normally, we already know that market is on an uptrend. That's already been gotten. But we already know that price being on an uptrend consists of it making higher highs than higher lows. That is what an uptrend means. So it means that for every new higher low that market makes, a new high has to be made in the market. If market makes, same here, market made a higher high, made a higher low, where price went up to what? To make a new higher high. So we don't know that what it means is that the logical thing to do for gold, or any pair that you analyze, let's say this is any pair, GBP, JPY, gold, whichever. Whenever this structure shift has been confirmed, that price is now going to form a new leg, it means that you should focus only on buys until market completes the cycle of an uptrend by making a new higher high. because we're on an uptrend, and an uptrend is known for what? Higher highs and higher lows. So as market made a higher low and then gave you a market, the strategy that you trade for reversals, while at the zone where you're expecting reversals from, it means that the buyers, what you're expecting price to do is to go and what? And make a new high. So in that sense, it is not advisable to be looking for sells when market has not yet completed the cycle of an uptrend by making a new higher high. It means that any POI that you see that is supposed to sell the market down, if that sell is going to hold, it's only going to be temporal until price finds a new point of interest for buy continuations. So the pattern of an uptrend is higher highs and higher lows. And remember, it's a daily time frame zone. And remember, when you're dealing with daily time frame, it will take weeks for your target to hit. We've been buying gold since this is what this is May 21st, May 19 or May 17. May 17 till June 20 something. I've been bullish on gold and I've not been wrong. So, but most people now that are selling gold, when gold has not yet completed the cycle of the uptrend, for it to complete the cycle of an uptrend, it needs to take out this high and make a new higher high. That is when you can say that the uptrend has been what? Completed. Same thing as this. For this uptrend to be complete, market took out this high. It was only after taking out this high that eventually started coming down to make a what? A higher low. So before you can see a massive sell on gold, price needs to actually probably go and take out this high. So only after taking out this high, that price will now eventually come back again for a new higher low. So if it comes down probably at this zone, and if this zone also matches this trend line, this is where price may probably come down to. But when it comes here, you don't just start buying again. You go down to lower time frames and start looking for price to give you a market structure shift to the upside while it is at this zone that you're expecting price to bounce from. If it does that while at that zone, then you've confirmed the next move to the upside. Then you now focus on buys. So it means that each day that you wake up and price has not yet made a new high, you only focus on looking for buys on that particular pair. That's what it means that directional bias of the market at that moment is bullish, or the directional bias of the market at that moment is bearish. Are you guys following me up? You guys following me up? So should I go on? You guys following me up well, right? So it's raining. So the pattern that market is on at any given moment is very crucial. Once you get that, because there are only three ways that market moves. Market will only be moving in three patterns. Either it's trending up, or it's trending down, or it's ranging. Or it does not take time to discover the pattern that market is on. Once you open up your time frames and you just look at the market, you've already seen the pattern. If you open up, no one in their right mind will open up gold and see this whole movement here and say that gold is selling down. No one will open up GJ and see this whole movement here and say that GJ is selling down, because you can clearly see that it's transitioning to the upside, it's making higher highs. Even GJ here is what's making, is at this moment, is making higher highs than higher lows. Sorry. Higher highs than higher lows. When it takes a new high, makes a higher low, higher high, higher low. So next one, higher high. So that is so once you check that pattern of the market, it will tell you the trend of the market. Daily time frame, 4 hours time frame, whichever one you check, you will actually discover that the pattern of the market is actually either bearish or bullish. This is daily time frame. It's still clear that this is an uptrend. So what you do is now draw out that trend and draw out zones where markets can come down to. Depending on that trend, it will actually match with that zone. So if it's an order block zone, it will still match with your trend line. If it's a breaker block zone, it will still match with your trend line. But the thing is, when price comes to that zone, you don't just start buying immediately or selling immediately. You wait for price to now give you your confirmation, which is the strategy that you trade while market is at that zone for reversal. Even if you were not active when price came to that zone, let's say you came to this zone and price already pushed up here, what you need to do is just go down to your lower time frame, then just mark out that zone, then go back to like 15 minutes time frame, go down and check what happened when price actually hit that zone you're expecting that reversal from. If price hit this zone and you confirm on the 15 minutes time frame that there was a market structure shift, an inducement, and the POI was tapped, you've already marked that you've confirmed the next move to the upside. Now, once you've confirmed the next move to the upside, you have to observe the pattern that market has been making previously, markets repeats patterns. The previous patterns is what? Higher highs and higher lows. So that being said, a higher low has been made. What market needs to do next is what? To make a higher high. So that being said, you already know where market is going to. Why in fuck's sake would you now start opposing the direction of the market on the higher time frames? They will not see people selling from other blocks that they see inside 15 minutes time frame, 30 minutes time frame, 1 hour time frame, where market has not yet completed the cycle of an uptrend by making a new higher high. It's only when price completes that cycle of making a higher high that you can actually focus on looking for buys or for sales. But provided the market has not completed that cycle and made a new higher high, you focus on looking for trades in line with the direction of the market. So in this scenario for gold, it's the bullish move because here price hit this 4 hours daily breaker zone. Within this daily breaker, it's also in line with what this higher time frame is saying. And after price hit this zone, I think it was on the 4 hours time frame, it just pushed off, gave us a structure shift, and then tapped this other block here for continuation of a buy. So I confirmed that market was already bullish. So when I confirmed it, I knew that where price was heading to was to complete the cycle of an uptrend by making a new higher high. So because of that, I never once opposed and started looking for sales on gold. I focused on looking for buys. The only time I ever took sales on gold was when I knew that this zone that price was supposed to tap to price has not yet gotten here. That was why I focused on looking for sales until price eventually go to this zone, this breaker block zone, and the trend line tap before I started. So when I confirmed that move to the upside with this, I never for once looked for sales on gold. I took a buy here. I took another buy. I took another buy here. I took another buy again. I think I took another previous buy, but I don't have it marked out here. So I was only trading with one direction on gold because of what? Because I confirmed directional bias of the market on the higher time frame. So once you confirm that directional bias of the market on the higher time frame, you keep looking for more buys. Any retracement, any sell should be for you to look for more opportunities to join into a buy. So when market sold from here to down, I looked for only a buy. When price sold from here, I looked for a buy. When price, I looked for a buy. When price went up here, sold that I still looked for another buy opportunity again, which is this zone that I'm expecting price to pull down to. So I focus mostly on trading in line with what the higher time frame is saying, even though I'm not a swing trader, but I have an idea of where price is going at a swing zone. So even every single day that I wake up, all I need to do is what? To find the strategy that I trade, but now I know the direction I'm trading at, and I know the point of interest I'm looking at, a bullish one. So I'll focus on looking for, it's easier to actually get points of interest when you know where market is going to. If you are skeptical on whether market is bullish or bearish, you will see points of interest everywhere. You will get stopped out everywhere. But if you are only trading in line with one direction, even if you get stopped out, it's still very possible that market will still go in your direction. All you need to do is what? To readjust and look for another point of interest. But when you're not sure of the direction of the market, you keep getting stopped out, trading opposite of where the market is going to. And that is the worst kind of stop loss to hit. So when you confirm that direction of the market on the 4 hours time frame or on the daily time frame, I use mostly daily time frame, depending on how volatile the pair is, or the time frame that gives, but only 4 hours of daily time frame. So once you identify the pattern that market is on. If it's an uptrend, you mark out your trend line, then draw out zones that price can come down to. When price comes down to those zones, you don't just jump in. You now go down to lower time frame and look for that confirmation while price is at that zone. Same thing happened here. Sorry. When gold made this buy here, when I drew this zone and price tapped here for the buy. And remember, whenever price taps any point of interest on a higher time frame, there must always be a retracement. Markets cannot come to a daily time frame and tap a daily time frame zone and not retrace. It will tap it. If it's bullish, it will tap it, push to the upside, and eventually it must retrace. That retracement is now where you are getting that confirmation to know that, okay, price is now worth trading in line with your direction. So, for example, this trade, this was when market taps this zone on the daily time frame trend line. When price taps here, it's also a breaker block here. When price taps here, you now go down to lower time frame. So, for example, you can go down to 30 minutes time frame. Excuse me. On my network. Okay. So when price taps here, so in this zone, went down to 30 minutes time frame, the price took out this high. That was a structure shift, gave us inducement, and eventually taps here, this other block down here. This is the other block here where I'm coming. Let me price not tap it. I'm coming. This is just refreshed. I don't know if it's my network. But you understand what I'm saying? When price comes to those zones that you marked out, the trend line zones, you wait for price to what give you a confirmation that you trade for reverse. So once price gets there, you have to now wait for that confirmation that you trade for reversals. And what we trade for reversal is was market structure shift, inducement, and our point of interest. So back then, so when price is there, you now start waiting for price to give you that strategy that you trade for reversals, which is what market structure shifts, inducement, and then your point of interest getting tapped. So you guys following me up? Don't know why my network is missing. I'm trying to show something. Okay. So when price tapped the zone for reversal, it now gave us what? A structure shift, gave us inducement, then tapped our point of interest here. So this was where price actually started reversing from. I think this here. So down here. Exactly, yes. So this zone was not mitigated. If you look at it closely, this was in the inducement. So price actually came back to mitigate the breaker block properly. So it was only when price mitigated this zone that we confirmed this move to the upside, which is this other block. So when price mitigated and gave us this structure shift inducement and point of interest, we confirmed the move to the upside. So once this started happening, I focused only on looking for buys. So you take your first trade here, a buy. Your second trade from this breaker block here, another buy. Your third trade from this other block here, another buy. So you focus on looking for buys until market completes the cycle of what? An uptrend by making a new higher high. So that being said, it means that the directional bias of the market is what? Bullish. That's the whole thing I've been talking about, directional bias, directional bias, directional bias. It just means trade in line with what the higher time frame is saying, because there are only three possible ways that markets can make its movement. Either it's trending to the upside or to the downside or is ranging. So whichever one market is doing, you find a way to join on it. So even the GBP JPY as of last week, I used 4 hours time frame to determine this directional bias. Now, I noticed that price was already bullish because of what market was doing. It was making higher highs and higher lows. So I drew out my trend line and it connected with this. It's connected, sorry. So I first drew out my trend line and it's connected here. After connecting here, I also noticed that this, I don't know if you guys have seen this kind of, but this is a demand zone or another block zone too. I have marked out this zone as a place that market can possibly pull down to. But the thing is that I did not just jump in when price got here. I already determined that the pattern of the market is what? An uptrend, and it's making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So I'm expecting them when price does this, the next target for market is what? To make a new higher high by taking out this previously existing high. So it means that when I confirm the move to the upside is what? Bullish, there's nothing that will take me to start looking for sales until the cycle of an uptrend has been completed. So once price hit this zone, what I did was go down to 15 minutes time frame because market was volatile at that moment. So I went down to 15 minutes time frame. Then what I saw was after price hit this zone, that was before price approached this zone on the 15 minutes time frame, was already on a downtrend. It was making lower highs and lower lows. Lower highs then lower lows, lower highs then lower lows, lower highs then lower lows, lower highs then lower lows. Then price eventually came here and then took out this high. This was the last high in the market. After price took out this zone, I've gotten the structure shift to the upside. Then what I wait for next is what? My inducement. Now, the inducement, like I said, the inducement is any retracement to the downside or to the upside after your structure shift. So this was when market took out here, this last high. So this was the structure sheet. I'm waiting for what? A retracement. Then this candle here, this particular candle that put back down here before pushing up here is my inducement. Then after that, I'll look for my point of interest. So there is what? A breaker block here, another breaker block here. So there are 2 points of interest and then this other block. So the one I'll pick is the one closest to my inducement. Where is my inducement? This here, this candle. Then my POI is what? This breaker block here. This was the entry for the trade. So once price did this particular thing here, it's already confirmed the move to the upside has already started. So once I took this trade here, my take profit level will be aimed at a new high, which was taking this trade from this level. Stop loss below the last candle to the break, and then take profit level will be, once I go to the 4 hours time frame, I will look at a new high, which is exactly here. So this was where the buy for DJ came. So now what I will do is, because this may not happen, this TP may not hit in one day, but provided the market has not yet hit that TP and making a new high, every day that I wake up, I will look for more opportunities to join into what I buy. So came here, took out this high, took out this high plus other existing highs here. This is this high and then this high too. So after doing that, gave inducement here, then pushed up, and eventually the price came here and triggered from this breaker block, and then a second buy continued. So now how many buys do we have? We've gotten a first buy here. We've gotten a second buy here. Now we really know that the directional bias of the market is bullish. We've gotten a second buy here from this breaker block, all while still targeting that higher high in the market. After that, price gave us another option again by taking out this high and then this high inducement, and then our trade from this breaker block here. Market actually snapped down here, but this is the last candle of the breaker down here, these two candles. So if we took this trade again, we have what? Another buy. Still targeting where? The last high in the market. Now see how easier it is to find POIs with a direction in mind. Now after this, price also came down again from this other block and then another buy again. So what? Third buy. No, fourth buy, right? Now, having a direction in mind will now make it easier for you to find points of interest. Basically, every point of interest here, price tabs, it respects it. Why? Because we're in line with the current direction of the market. Another buy here. After that, price took out this high, while also taking out existing highs here. After that, price came here and gave us what? An inducement. And then pushed up. Eventually, it came down and then bought again from this breaker block, which is this current buy. So now, how many buys? 1, 2, 3, 4, and 5 with what? Just one directional bias. Now, had it been I focused on sales, you know how many times price would have taken me out? But I focused on buys. 1 is to 15 risk to reward ratio, 1 is to 9, 1 is to 11, 1 is to 8, and 1 is to 7. Do you know how much you would make doing this? Trading in line with because already I know that for price to complete an uptrend cycle, it needs to make what? A higher high, because that is what price has been doing since. Whenever it hits this zone, a new higher high must be made. Is that zone a new higher? So that is an uptrend, higher highs, higher lows. So having that in mind, that an uptrend is made up of higher highs and higher lows, each buy that I take or each new higher low that market makes, the next stop will be for market to what? To complete the cycle and make a higher high. That is it for you guys following me. It's clear, right? You guys are following me up, right? Okay. So that is that simple. Same thing for uptrends, but I don't think I've traded pairs that are on uptrends mostly, but it's still the same thing that you do for uptrends that you do for downtrends too. For downtrends, I've not really to express that I've been entirely bearish, but downtrends, the same thing. But I think I have to use patterns to explain this. So downtrends, let's say we have markets on a downtrend for any pair. When price is on a downtrend, it's making lower highs, then lower lows. 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 So if you check out, market is on a particular pattern, lower highs, then lower lows. Then you draw out your trend line for that pattern. It will connect. So while it connects, at the same time, price will also be reacting at zones. So if you pay attention, when market made this lower high, it actually tapped into a breaker block zone. When market made this lower high here, it's also tapped into this what breaker block zone here. So what you're expecting price to do is what? Now that it has made a lower low, next thing it's going to do is what? Make a lower high. So normally we expect price to what? Tap into what? This next breaker zone, while also being in line with the trend line. So you're expecting price to tap into this zone. So normally price is expected to come and what? To come here and tap here. So you really know that the pattern of the market is what? A downtrend. But you don't just start selling while prices at this level. So this is a daily time frame or the 4 hours time frame. Depending on the time frame, because I only use 4 hours and daily time frame to confirm directional bias. Regardless of the time frame it is, when price is there, you now scroll to your 15 minutes time frame, 30 minutes time frame, depending on how volatile the market is at that moment. So whenever you go to those lower time frames to get that first, because that first confirmation is really everything. Once market needs to give you a market structure shift while at the zone you're expecting price to reverse from. That has to happen, even if you did not catch that first move, but you have to ensure that you saw that thing happen before you can focus on the directional bias. So we are bearish here, for example, we expect price to what? Give us a market structure shift to the downside while at this level, give us our inducement, then tap into our POI. So on the daily time frame or on the 4 hours time frame, you can be priced doing something like this. Remember, for every move that market does, it will always make a retracement. So when price does something like this on the daily time frame, on the 15 minutes or 30 minutes time frame, it can be priced doing this: higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. Then when it starts this particular trend line and the zone you're expecting the reversal from, you expect market to give you what? A market structure shift to the downside. While at this level, give you inducement, go down, then eventually come and tap your point of interest for reversal, then start selling. Once this has happened, while price was at this level, you've confirmed the next move to do. You guys are typing. Can't you guys hear me? A lot of messages going into this thing. So when price taps that POI, you start the whole once it gives that confirmation, you start the whole bearish. Now pay attention. It's not only with trends that you use or this thing. It's not only when price taps into your POI for a trend or an uptrend, a downtrend. You can also use your order block and your breaker block for this directional bias. For example, if on the daily time frame you saw something like this happen, let's say on the daily time frame market's already bearish, making lower highs and lower lows, then gives you structure shifts, gives you inducement, goes up, and eventually comes to tap your order block. If this is the daily time frame, you can still apply that same technical analysis that you do on your lower time frame for this on the daily time frame also. The only difference between the daily time frame and the lower time frame is that the lower time frame will probably hit your target so fast in one day, sometimes 1 hour, 4 hours. But if it's daily time frame, this will probably take you about 1 month for this target to eventually hit. So it's not only about trends. The only thing that I advise you guys to do is whenever you start analyzing first, just go to your daily time frame or the 4 hours time frame and observe the pattern that market is giving you. If it's an uptrend, with what I've taught, find a way to jump into the uptrend. If it's a downtrend, what I've taught, find a way to jump into the downtrend. If it's still market giving you a structure shift, inducement and POI and tapping into your order block, same thing. When price is here on the daily time frame, go down to 15 minutes time frame and start looking for the strategy that you trade for reversals while price at that daily time frame order block. Once that has happened there and you confirmed that the move to the upside has started, because it has to give you that strategy that you trade for reversal while markets are that zone that you're expecting reversals from. It can even be a support zone, but once price gives you that thing while at that level, they've confirmed the next move to the upside. And the main thing is that since it's daily time frame, it will probably take you 1 full month for you to hit target. Means that for a full month, you should only be focused on what? Buying. So regardless of it being a downtrend or an uptrend or a ranging market, you can still trade market structure shift, inducement, point of interest, getting the point of interest on your daily time frame. This right here that just happened is basically that price took out this high. This is 4 hours. Then came down here and gave us inducement. Then tapped this other block on the 4 hours time frame. This is still in line with a trend line. But even if I didn't want to focus on using trend lines, I would have still waited for price to give me this confirmation while it's at this 4 hours zone, because this is still what we trade: market structure, inducement, point of interest. So even if you don't want to look at it as from a trend point of view, even this gold now, if a break of structure, there is still inducement here, and price still came to tap into our breaker block, this is still the same thing that we trade on lower time frames. The thing is that before you start looking for it on lower time frames, look at the higher time frame to actually know where market is going to. Because when you trade in line with what the higher time frame is saying, your points of interest tend to respect itself much more. So even if you're not trading with trend, even if you don't draw out your trend line and you looked at the daily time frame, there's no way you would have missed this breaker block on the daily time frame. You would have not missed this break of structure, you would have not missed inducement, and you would have not missed this breaker block here. Even if you're not trading with trend lines at all. So the same analysis that you apply on your lower time frame, first of all, try to apply it on your higher time frame. The thing is that you only need to check the higher time frame once for you to trade this thing for a whole month. You can check the higher time frame once and confirm this. For the rest of the month, you're not looking at higher time frames again. Only thing you need to do is what? Mark that line where price is going to. Then now start looking at lower time frames and trade in line with where price is going to until price eventually gets to that zone. So the only thing is that with lower time frames, once you get to your structure shift inducement POI, your take profit level will hit in 1 day or 4 hours or 1 hour, depending on the time frame that you used. But once you're using a daily time frame or 4 hours, whenever that POI hits, it will take a long time for the target to hit, meaning that you only need to check that's your directional bias once, then you focus on trading in line with that bias until price hits that zone. You guys following me up? Are you guys following me up? Okay. So the same analysis that you put on let me check I'm not really eligible, let me see. Okay, so the same analysis that you put on your lower time frames, you also put that analysis on your higher time frames. Something that market has been doing. When it was bullish, it was basically this uptrend. And now, let me see if I have a downtrend for it. For now, I have nothing on GG that I moved to another. Okay, there's a breaker here on GG actually. So me personally, what I would do if I'm trading GJ is GU. This is GBP/USD. I will just be focused because now I don't really know what market is doing at this particular moment. It has not given me enough data for me to actually start looking for any trades here. For now, I don't really know what market is doing at this level. But I know that price gave me a break of structure here. There's inducement and there's a breaker block where price may possibly come down to react. Now, what I'm looking out for is when price comes to this zone, I'm expecting market to give me a market structure shift to the upside, give me an inducement, and still give me my point of interest that I trade. Let me see if it's in line with anything like trend lines. I'm not sure if it's going to be in line with a trend line, but I'm explaining what I'll possibly do. When price comes down to this GPJPY, this GPUSD zone, I have my inducement here. Sorry. So what I'm expecting price to do is when it comes here, before I can focus on looking for any buys here, when market has gotten to this level, I will not have to go down to 15 minutes time frame. On the 15 minutes time frame, I'm expecting market to now be displaying something like this: lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. Then I'm expecting market to give me a structure shift, inducement, then with the rules I trade to tap my POI and then start moving up. Only when market gives me this pattern while at this particular breaker block here. That is when, and to be honest, market seems bullish because this is it now. If you just look at GPUSD, this is an extremely bullish structure. It's already bullish now, higher highs and higher lows, higher highs and higher lows, higher highs. The last higher low that markets made actually reacted with this breaker block here. You guys can see this breaker block at this level down here. That was where price reacted. Let me see if there was any confirmations at that level. If only if my trading will allow me to go back to that data. Let me see. Okay. So I think when price hit this zone, it's not really that clear, but I will see price took out this high and eventually just came down to this other block direct before the whole move started again. I think it still gave another confirmation, taking out, okay, yeah, lower highs, lower lows, lower highs, lower lows, gave a structure shift, gave inducement here, and the inducement mitigated the breaker block, and eventually it came down and mitigated this other block zone here. So for me to confirm the move to the upside, while markets at this zone, it had to give me this strategy that I trade for reversal while at that zone. So when market gave me this, while at this level that I marked out, that breaker block on the 4 hours time frame, structure lower highs, lower lows, lower highs, lower lows. It took out this high, then came back, gave inducement here, and pushed back up. Eventually, it came down for this other block here, that this other block zone here. That was where the buy started from. So that was what confirmed this buy to the upside, and it kept buying. Now the last high in the market was where? Hang on. The last high in the market at that level was around. Wait, I'm trying for this thing to load properly. I don't know what's wrong with my network. Where did I get that trade from? Exactly. This was the zone I got it from, a 4 hours breaker block, or was daily time frame was what I was using, but it was around this zone, this breaker block at this level. Now after price did this, we already know that the GBP USD was already on an uptrend, and what the uptrend is made up of what? Higher highs and higher lows. So what was the last high? The last high was here. So since the last high was here, that means that we're targeting for price to make a what? A new high. Now, for price to make a new high, it needs to take out this previously existing high. It means that the directional bias of GBP USD as of that time was what? It being bullish. So it means that the first buy you took from here, you continue taking more buys until price takes out the last high in the market. Then that means that the cycle of the uptrend had been completed. So the same thing that you put into this is still the same double break of structure, taking out this high and then this existing high, giving you your inducement here. Then coming to tap into your breaker block, which is this breaker block here. So it's the same thing we trade on lower frames. But the thing is, when you trade on higher time frames, it's going to last for a long period of time. So it means that every single day you wake up, you focus on looking for only buys for that particular pair. If you want to sell from there to your POI, that's up to you. I don't trade against the bias of the market. Once I get my bias, I wait for price to get. That's where the patience comes through in trading, because you can start selling and price will eventually make new highs before eventually coming down to that your POI. I don't really do that whole thing. I focus on waiting for my POI to approach. You guys following me up? So far, is you guys understand what I'm saying so far. So now, knowing that the directional bias of this GBP USD, I'm not checking this thing again. Don't worry, I'm not here to check price for you guys. Now, this GBP USD now, from what happened here, you focused on only buys because you know that price needs to complete the cycle of what? Of an order of an uptrend. Because already, if you come to GBP USD and just look at the charts already, you already know that it's trending up. It's very clear that GBP USD is bullish. It's very, very clear that it's bullish because of what market has been doing. Higher highs and higher lows, higher highs and higher. So it's what is bullish. Let me see. Let me draw out something. Okay. This is also another zone that price may react to as it matches this trend and other blocks level here. So if it gives that structure shift when it gets to this zone first, inducement and your POI, then it means that this is where the buy will start, and then this is the way the target for this new high to be taken out. But if price does not give that while market is here, then it means that I'm not looking at this zone. Then it's this next one. So you don't anticipate the market. We trade from what the market has already given us. So I have this zone marked out because it's an order block level, and the order block level also matches what my trend line. Now, when price comes here and I go to my lower time frames and I actually see market give me a market structure shift, a proper inducement, and the POI, while market is at this level, and it also matches my what? My trend line, then I can continue and take a buy from here. Only when that pattern happens while market is here. Then when I start buying, I'll focus on looking for buys until this high in the market gets taken out, which means that every single day that I wake up, I'll focus on looking for what? Only buys until markets complete the cycle of an uptrend by taking out this previously existing high. Then I'll rest and I'll. So you guys understand what I mean, right? You guys are following me up. You guys are following me up proper, right? Exactly. So this is as simple as that. Actually, it's as simple as that. Once one cycle of a trend completes, you you wait for the next zone that price can come to. Then you look for the strategy that you trade for reversal while market is at that zone. Then once it happens while market is at that zone, you now get that the new cycle for that trend is about to begin again. Then you look for the pattern for that trend, and that will tell you where your take profit level will be. So every single day that you wake up and market has not yet gotten to that level, you keep trading in line with that current trend until price completes that cycle. Be it a bearish one and be it a bullish one, it is the same thing. Now, aside trends, there's also another way that market moves, which is what? Market ranging. Market ranges from support and resistance, support and resistance. But the thing is that the pairs that I trade, majority of the time, is always trending. And whenever I try to, in fact, I prefer trending pairs because it's actually a bit easier to trade. The GBP JPY that I've looked at 3 pairs for you guys now: gold, GBP JPY, and GBP USD. All with the same thing I just taught you guys here, 3 different pairs. Now, once I open up a pair and I don't see that, I don't try to force it. I leave the pair alone and I go to another pair. You will not die analyzing a particular setup. Once you open up and it's not easy and you're trying to force yourself to see something there, I beg, leave that pair alone. So there's another way that markets also moves is what? Ranging markets. We already talked about the trending markets, downtrend, uptrend. It's now to move to the ranging market. The ranging part of it is where market is basically stagnant and is consolidating from support and resistance, support and resistance, support and resistance. That is what a ranging market is all about. Now, what you do is that for the ranging market, we try to look for the ranging market movement on a higher time frame, which is probably like the 4 hours time frame or like the daily time frame, whichever time. But we'll focus on higher time frames because it will take a long period of time for a full cycle to complete if you're taking your directional bias from a higher time frame. If price is moving from support to resistance on 1 minute time frame, it may take 3 minutes for TP to hit. That means for 3 minutes you are done trading. But if price is ranging on a daily time frame, it will probably take you a whole full week or a whole full month for your take profit level to hit, for a whole complete cycle of a range to hit. So normally, price ranges from where? From support to resistance, resistance to support, support to resistance, resistance to support. Sometimes price can even go deep inside the support, then pull back again, go to the resistance up here, then pull down again. It happens. That is why you don't just jump into a trade when price gets to that zone on the higher time frame, because higher time frame is a lot trickier. Because price will get there, you can actually go deep inside your other block or deep in that kind of thing. But the main thing is that once you mark out the zones that market can come to, you don't just jump in, you wait for the pattern, for the strategy that you trade for reversals while markets at that zone expecting reversals to come from. So, for example, if it's a ranging market, normally a ranging market is made up of price moving from support to resistance, resistance to support. So while price is at support, we're expecting price to buy back up to resistance. That is the whole thing of a ranging market. Now, you don't just jump in because price can take you out and see you go in your direction. So what you do is you mark out the zones where price can possibly come to. So ranging from support and resistance So this is the support, this is what the resistance. So while price is here at the resistance level, you don't just start buying. You wait for price to now give you what? Because on the daily time frame, this can be priced at the support and it may start pushing to the upside a bit. But while it's here on the 15 minutes time frame, it can be market what? Making lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. Then while it's at this level, it's also what? At this level. Then this small push to the upside, maybe market doing something like this, market structure shift, inducement, then coming back to trigger your point of interest. Only when this happens, while prices at this range of the support, that's when you can confirm that the move to the upside has started. Then price will start buying, and then the target for a range is what? Is going from support to resistance. That is the whole target for a range, meaning that as price started buying from the support, the target for the market is what? To go to the resistance level. You guys following me? Okay. So the whole side, so once this happens, once this market structure shift, inducement and point of interest happens, while price is at that level, which is the support level in this case because it's a ranging market, while price is at the level that you're expecting reversal from, it means that the move to the resistance has been confirmed. So every single day that you wake up and price has not yet gotten to this resistance level, you keep focusing on buys. So this can be the first day. Second day, price may be here. Third day, price may be here. Fourth day, price may be here. Fifth day, price may retrace down. Sixth day, price may be here. Seventh day, but you keep looking for buys until price comes towards the resistance level. And then for you to be getting these continuations for each day, price will be giving you your POIs. So you can see price can give you an inducement here. You know that your POI is what? This breaker block. It will push up. Then the next day, price may still come again and then buy from what? Another block level, keep pushing. While all this is happening, is reflecting with one candle on the daily time frame. Eventually, the price will keep buying until it comes to this resistance, then you stop the buy. Then for you to now confirm that market is going to go to the next range, which is the next range of selling to the support level. While market is at this level, you need to see what price give you what? A market structure shift. Then inducement, then your point of interest. Once this pattern and this strategy occurs while price at this next level of the range, then that's confirmed the move to the downside, which means you will now continue selling and looking for more sales on the lower time frame until price eventually hits the next range, which is the support level. I wouldn't say simple, but I feel like if we have the patience to wait for all these things to happen, and it's not like you're looking for your directional bias every day. Trust me, you only have to get it once. Then you mark out the target. It means that every single day you wake up, you don't even need to look at directional bias again. All you need to do is just what? Look for your point of interest or your strategy that you trade in line with directional bias that you already had since. Trust me, when I had the buy for this gold, let me show you when I had the buy for this gold. Let me show you. This was May 19, and I had my target here. Since May 19, I've not looked at the directional bias of the market for gold because I knew where price was heading to. I focused on buys on gold, and I'm still currently buying, and price is almost at that level. So your directional bias is just something you need to confirm once and trade for a long period of time. The longevity of confirming directional bias on the daily time frame is very nice because you don't even have to hold the trade for a swing because it will take a long period of time for your take profit level to hit, except the market is extremely volatile or something has happened. Maybe there's war or something, and the market is extremely volatile. But normally, per day, you can trade the market. So um, it's that simple. The same technicals that you can put on your lower time frames, put it on the higher time frames because it will take a long period of time to complete. So once you now get it with the higher time frames, all you need to do is now to go to lower time frames, then now start trading in line with already what you marked out on the higher time frames. That is it for directional bias. So if you guys have any questions, just use this to raise up your hands and I will pick you to answer your question.
Hello, sir. Hello, good evening.
Hello. Good
Good
evening.
evening. Okay, sir.
Good
Since
evening.
you are talking about this directional bias, so my question is, what if, for instance, you taught us trend line liquidity, and you say taking this thing, taking trades from inside liquidity, you might be stopping.
Can't hear you.
So once the market gets there, will you still look for that entry? Let me say for a buy.
I didn't hear what you said.
Hello, sir. Okay, sorry. I said then you taught us about liquidity on the last class. So my question is, what if your POY on that higher time frame is below your trend line? And now since market have broken below that trend line,
Yeah.
you are meant to look for a sales. Like so market can clear the entire trend line liquidity, right? So once market gets to that your POY that is inside that trend line, that is inside that trend line and that liquidity area, will you look for your reversals at that place, or you wait for market to clear the entire trend line first before looking for reversals?
It's your trend line or higher time
Yes, like you're
frame.
like
You may
on
still
your
pull
higher
back
time
to the
frame, but let
upside
me
to
say market
trigger
break.
the point of interest that even triggered that break of. If it breaks, then you make your analysis. Now, remember when I said that if you have a trend, focus on trading in line with that trend, not looking for the break of that trend. It's only when market reverses and gives you confirmation for reversal that if you're expecting market to give you a strategy.
Ah, where's the host now? Host have disappeared. Who is this Vera James? I'm not the new host. Who is Vera James? DM me. Hello, sir. Are you there? Hello, sir. Hmm. Who is Vera James? Can you hear me? DM me. DM me on WhatsApp. Are you on the WhatsApp group? I'm not the host.
What's in this one they talk?
Hello, sir. Are you there?
I'm here. My network cut me off.
Okay. So you were saying something before.
When we are dealing with trend lines, we're not looking to do trend line liquidity on the higher time frames. If market is on a directional bias for a trend line, it focuses on following that trend. The whole direct liquidity and now is when markets already hit a zone for reversal, and you already confirmed the zone for reversal has already hit. That's when you now use the whole trend line as take profit. The only way you can now start using this trend line is if there was a zone for reversal at this level. Let's say you already had a structure shift here in this here, something like this happening,
I can't
and
see your
then
screen
you already
though.
confirmed the whole structure shift inducement. Oh, sorry. Um, yeah, let's say on the higher time frame, we already got the whole structure shift and whatever, and market's already bearish. You would know that price is bearish when price, like I said, you can put the same thing you put on technical analysis, the same structure shift inducement and POI you put on your um on your lower time frames on the higher time frames. So if, for example, now you've gotten a POI that's supposed to reverse the market and it's up here, and then the pattern on the daily time frame that price used to approach it is a trend, then you can use that trend line liquidity. But you don't say, okay, when price comes in and it fails to buy from here, I will start looking to clear trend line liquidity. No, because you don't have a zone that caused a reversal at this level. So you're not looking for anything.
So
You're
sir,
just
on
looking for
that
price
on
to
that on that
continue the
GJ.
bullishness. If
So So on that GJ, on that GBP JPY, now like since price have already reached that high, the recent highs in the market on GBP JPY. So is it and there's another block there on the 4 hours time frame. There's another block on GBP JPY. So is it okay if we start looking for sales to that other block, then
I
before
don't know
before
for
looking for
you,
buys?
you cannot start trading something that market has not confirm for you. That's a higher time
No,
frame
like if we
POI.
see a
For you to start
reversal.
looking for sales, you have to see a structural shift at that level. Let me finish talking. You have to see market give you a structural shift at that level. That other block you have, and if it fits the whole criteria, the whole that your market is bearish, you have the structural shift one market at that other block, your inducement time period. That's when you can now start selling. You don't just start when market has not given you that confirmation. You trade what the market tells you. You don't
Okay.
anticipate a move.
Okay. Thank you, sir.
I'm zooming using.
Hello, sir.
Hello.
Yeah, my question is quite not really as related as to what we have discussed. It's just really about finance in general, because there is a place of greed in trading, and there's a place of you're trying to level up. So, like, how do you advise us that are you know going into like trying to level up when it comes to like trading? Now, the strategy is not going to be a problem because of what we have and the resources that have given to us. And if we follow it by principle, we should be able to make productive use of it. But now the thing is, how do we level up when it comes to like um managing the risk? What should you feel okay risking? If, for example, if you are starting out with maybe $1,000 and you are going up gradually with this strategy, you got into a place, like, how do you manage yourself within the risk? Do you just say going all out, or like just what? How do you manage it? Because I think this is one of the topics that so many people don't get to ask their mentors, and then they keep.
That's not what the class is. This class is about technical analysis. The whole leveling up thing is you planning yourself. I can't, you can't, someone else cannot plan for you. If you have to be the one to actually plan yourself, if I open up my notes, I have plans of the capital size I need. I have plans of what I will do when I get that capital size. I have plans of what I do with the first withdrawals to ensure that I will always have capital. That's just a personal thing. The technicals is what the class is about. But you planning yourself is something you have to do as a trader for yourself. Leveling up is something you have to come down and plan based on how you see funds and how funds come to someone else. If I can't relate to everyone because someone here might already have $100,000 to trade with. There are people that only have 1K. There are people that have 100. There are people that even have $1 million. I can't tell you and resonate with you on your like on how it's not a general thing. I can't resonate with someone else with a situation that they are not currently facing. So leveling up, most people already have capital and all they need is just technical analysis. The class here is based on technicals. If it's about you as a person, you have to look deep into yourself and know how you can level up yourself. Me, the way I level up may not be the same way that you level up. Most people pick preference, most people pick flipping, most people pick extreme risk. Most people just walk somewhere and get the capital and level up with it. So it's a personal thing. It's not really a thing that resonates with everyone. It's a personal thing.
Thank you very much, sir.
Vera. Vera. Vera.
Hello, can you hear me?
Mhm. Yes, ma'am. Can you hear me?
I was talking about the double dose of structure. Like, it's very hard. Like, I don't even understand it like that. I don't even know the high that we're going to be looking out for. And
Vera.
yeah,
No, you asked this thing for last class.
I asked, but nobody explained to me now.
But it's not hard. I can't explain the thing 10 times with the same way now. I don't know how else to explain it than, this is not a beginner class. A break
I
of
don't
structure is
know.
something that you learn from Candlestick Bible. I know now, but
Yeah,
if you know you're supposed to know break of structure from Candlestick Bible. After that, your double break of structure is just when two zones gets taken out. It's not really difficult. When market breaks, if there are those that have been existing in the market before and price takes it out and takes out the previous existing zones, that's a double breakout structure. Really don't know how else to explain it, to be honest. Like I
I
don't
don't know
really know
how.
how else to explain it. But
That one is
that's
not the
what
issue. Then,
can
there is one I'm pinpointing at.
What's
Like,
the issue?
let me just say, let me just look at the 1 hour time frame. Before price will break out, like let me just say a major like break of structure, the major high. Let me just put it like the swing high. There will be this kind of internal like break of structure, the small ones like inside that range. That's what I'm looking. That's what I'm talking about. That this particular
There's
one,
not
I'm
like
just
external break of structure. Okay, let me give you this is an example of a double break of structure now. This is a high. This week now is a high. This is also another high. Eventually, the price came here and then took out those high and these previously existing ones. That is a double break of structure. You don't need to complicate the whole thing. As long as there are two zones that were existing already there and price takes them out, that's a double break of structure. I don't know how else to explain it, but I think you just need to make more research on. You can probably try YouTube and get it clearer. But for this particular class, I've taught it how I know to teach it. I can't explain anything again on double break of structures. I've done that like
you're in this.
twice, thrice, even now.
Okay.
My
The
words?
second question, your inducement, like is it one candlestick?
Mm.
Because that your GBP there's a pullback there, but you just pick that other one that was just closer to it. Like how just that single one, but there was a deeper pullback
It's
on
the
that
first
other one.
it can be one single, it can be one single candle like this now. When price took out this high, I did not focus on taking out this as my inducement. Why? Because there has not been any double break take out this high also that I marked my double break of structure, this high and then this high. Then the next candle that comes, okay, let me use this one for example. Sorry. This
Let's
one
just use
that
that
price
GBPY.
has reacted to. So price took out, let me finish now. So this particular pair, this GPUSD, price took out, came here, it did not take out this high, but this one, this next candle took out this high, and then this previously existing zone here, that's a double break of structure. Then the next candlestick this week is now the inducement. I think, you see, there's some trades that that may confuse you now, but the more you trade the strategy, the easier it becomes. This is just the first month. In fact, we're not even done with, like, we just got done with the class today. So I feel like the more you trade and the more experience you have, the easier it becomes for you. It's not something that you just, even after this class, you're still supposed to go back and have like an extensive study period for like a whole 2 weeks studying and then trading only demo accounts for that period of time until you become profitable trading that demo account. That's when you can now hop on a regular. So the experience will also come with it, and it becomes easier. There are some things that you can spot with experience. I'm not going to lie to you and say that learning the strategy is enough for everything. After learning it, you see how to have experience trading the whole market for you to get that kind of level of experience that I have now. That things like this will not have to confuse you. That's just it. So even if it's confusing you now, no problem. Don't focus on the pairs like this night catch. Focus on your own first. You don't have to catch every single trade I catch because you didn't catch all the losses I caught. When I was learning it, the amount of losses I've taken learning it, you have not taken it yet. So you don't expect to still catch the amount of profits that I catch now that I have that experience. So you get the ones you can get, and the ones you can't get, you focus on advancing until you advance yourself. You will not get everything in one setting. You will not tell me that you've not seen trades that you caught that actually went in your direction. You will make profit from those ones. So until you have that experience, then and because there are some trades that I catch that some other traders cannot still catch. There's some other traders catch that I still don't even catch, but we all still trade the same thing. So whichever one you see, you take it.
Okay, thank you.
Yusuf.
Good evening, boss. Good evening, boss. Please, are you hearing me?
Yeah, good evening.
My question is about
They can hear you.
my question is about the double break of structure. I'm a little confused about it.
Okay, Yusuf.
Yeah. Assuming the
What's
market has
confusing?
already given us a double break of structure and an inducement. Are we to pick the extreme break of structure or the internal break of structure when we are to trade, when we are to get our point of interest?
It depends on where your inducement is. If your inducement did not mitigate that extreme one, you can pick the extreme one. This, for example, we picked the extreme one, we did not pick this one. Understand? Because price did not mitigate that extreme one. In fact, it's even from here itself, this one. So whichever wherever your inducement is, you follow those 4 rules. If your inducement happen to have mitigated this one, then you move to this next one. If your inducement mitigated this one, you move to the internal one. So it all depends on where the inducement is.
If my inducement mitigated my first extreme zone, I'm going to get my entry from second internal liquidity, internal POI. Are you hearing me?
Sharp. Yes.
Okay, thank you. That's all.
I can hear you. I say sharp, no so now.
All right. Thank you so much.
All right. Problem. D.
Good evening. I didn't really start from the
Well,
beginning of
this
this
is 9
class, but
I've been sitting for 1 hour 30 minutes.
can you hear me?
Can hear you.
Okay, I didn't start from the beginning, but I heard you say
I can
something.
hear you.
I'm trying to confirm what you said. You said for a pair to complete its cycle, it must make a higher high. So my question is, when let's say a pair is in an uptrend and it made a higher low, and then it started going up, but instead of making a higher high, it now broke the last low. Does it mean that trend, that cycle is not complete yet?
If it breaks the last low, then it means the market is changing structure. So you now have to start looking for your structure, where your structure shift is the inducement, and then a POI to now start taking that structure shift to the other side.
Okay.
And last person. Nexus.
Hello,
Hello.
good evening, sir.
Good evening.
Sir, my question is that if there is a double boss and investment liquidity I, which is I am looking for, and but it did not take that liquidity and go upside in same trend. Can you hear me?
What did you say?
If there is a double boss break of structure
Yeah.
and I got my liquidity like investment
Mm-hmm.
and price did not take out the liquidity investment and it goes up higher in the same trend, and there is another break of structure in upside, and there is another liquidity like investment, but I'm confused that which one to choose as a POI. Means entry first was
The
not
first
very
the
clear.
first one is still valid. This something like this happening. After this, price still give another breakout structure. Eventually, the main zone will still get respected. Same thing as this. It left the breaker block,
Yes,
gave the
yes.
inducement, still continued moving to the upside. Eventually, price still came back. So eventually, it was going to happen. This next was I thought, okay. So eventually, price will trigger the zone. That's
Thank you, sir.
correct.
And I have one another question that hello,
That was your question.
sir. I want to know that if a price came to my trend line, the POI, which aligns with trend line, and there is market structure shift, everything which is I am looking for, and
Yeah.
suddenly after 2 or 3 boss break of structure, price did not reach full DP, means main break structure, which is needed to complete the cycle.
If you're correct with the technicals, and price actually gives you that structure shift and whatever, it should complete the
Yes,
cycle.
yes,
It should.
yes,
It
yes.
should. If you're correct, it should.
But suddenly it takes out many lows, means change in trend. Then what to do?
It
Should I look for buys and
it hardly happens. It hardly happens, but when it does, you can't really do anything. You just have to stay off the market. It's not everything you trade actually. When that happens, you just stay
right?
off the market. Like just
Thank
stay
you,
off
sir.
the
That's
market. It
my doubt.
happens. Just stay off the market when it happens. We don't really control the
Okay.
market. So whatever happens, sometimes news can actually affect this, like economic news, wars and all. So when it happens, the whole thing trend can change. Just have to stop the market and wait for a proper analysis later, or you go to another pay. So
Means
yeah.
it means that that is not for change the bias. Means we should not change bias for that move because of that move.
Just leave the market for that moment. Just because whatever made it change the whole buy, whatever made that thing happen, if you're properly if your analysis is probably correct, it wouldn't happen. But if it happens, then maybe just an economic event or something. Then just stay off the market for that moment until eventually you get a clear bias again, probably next week or so.
Oh, thank you, sir.
9:37. I'm going off soon now. I'm going to fix. This is the last person. So after this, this D, you already asked a question. Next week, you already asked a question. Gallant, that's
Yeah,
a
good evening,
question.
boss.
Yeah, good evening.
Yeah. So if on the 1 hour I can see maybe a clear breaker block, then I go to maybe the 30 minutes or 15 minutes, but all the breaker blocks that have been mitigated, can I still mark out that zone as
Yeah.
a valid breaker block?
What? What's the question
If
again?
if there's a breaker block on the 1 hour time frame, and maybe I go to the 15 minutes, maybe to get like a precise entry to mark out the breaker block there, but all the breaker blocks that have been mitigated, is that 1 hour breaker block still valid?
If the 1 hour breakable is not mitigated, then it's still valid now.
Okay. All right, thanks, boss.
All right. That is it. It's 1 hour, 38 minutes. So
Thank you, boss.
So that's it actually. So please, first of all, don't jump into the markets. You are still a newbie to this strategy, actually. So focus on back testing first. And no, right, you can actually forward test now, but don't trade on a real account for now, except you 100% are sure of what you're trading. It's risky. So focus on actually getting it down on a demo account first. Practice for a long period of time until it's already working for you. Then you can now go to a real account. You understand? Have plans. You understand? Have plans. Actually, your trading plan, how much you want to deposit. So all this kind of things is very important. Then have targets. Plan yourself. Actually, trading is actually easy. Once you have capital and have the patience to wait for your setup to form, it's actually very easy. So it was a pleasure teaching you guys, and we're still communicating in the group now. So
Okay, boss. Please help us drop your own plan so I can copy from it.